There is a desk in Tokyo. It is late, and the man sitting behind it is staring at a currency that refuses to cooperate, a bond market that has started sending warning signals, and an energy crisis thousands of miles away that is quietly pushing the price of everything higher. His name is Kazuo Ueda. He is the governor of the Bank of Japan, and the decision he is about to make could send shockwaves through every asset class on the planet, including the coins sitting in your crypto wallet right now. But here is what I really want you to think about before we go any further. While Ueda is wrestling with that desk in Tokyo, one of the most disciplined investors in the history of modern finance is sitting on $373 billion in cash. Not invested, not deployed, just sitting there, waiting. You do not accumulate a war chest that large when you think the future is cheap. You do that when you are quietly expecting a sale. Out of all this pressure, one narrative has started spreading like wildfire across the internet. Japan is breaking. A hidden chain reaction is ready to detonate. And when it does, XRP shoots to $1,000 a coin and single-handedly rescues the global financial system. I am not here to sell you that story, but I am also not here to simply tear it apart. What I am here to do is something far more valuable and far more rare. I want to sit with you, calmly, and draw a clean line between what is real and what is wishful thinking, dressed up in financial language. Stay with me through to the end of this video, and I promise you will walk away with something better than hype. You will walk away with clarity. One important note before we dive in. Nothing in this video is financial advice. I am not a financial advisor. This is simply how I read the situation, laid out honestly so that you can think it through for yourself. Take what resonates, question what does not, and always do your own research. Now, let us start with the foundation. The part that is not a rumor. The part that is documented, verified, and frankly dramatic enough without any embellishment at all. For decades, Japan ran the loosest monetary policy in the entire developed world. Interest rates hovering near zero, sometimes dipping below it. That extraordinarily cheap money became the silent engine underneath a massive slice of the global financial system. Trillions of dollars in global investments were quietly built on top of it, and for a long time, nobody had to think about what would happen when that engine changed. Now they do, because that engine is changing. The Japanese yen has slid back toward the 160 mark against the US dollar, erasing much of the relief that previous government interventions had managed to buy. Inflation inside Japan is climbing, pushed higher by energy costs tied directly to the conflict in the Middle East. And Governor Ueda has begun signaling something that markets have not heard in an entire generation. Japan may finally raise interest rates in a way that actually matters. The data backs that signal up completely. At the Bank of Japan's April policy meeting, the board split 6 votes to 3 in favor of action. That is the most divided the board has been under Ueda's leadership. Markets are now pricing in roughly an 80% probability of a rate hike at the June meeting, which would push Japan's benchmark rate toward 1%. Now, I know that sounds modest compared to interest rates in the United States, but you have to understand the historical weight behind that number. A genuine rate hike in Japan at this level would be the first serious monetary tightening the country has seen since the middle of the 1990s. There are people watching this video who were not alive the last time Japan did something like this. On top of that, Japan's crude oil reserves recently recorded one of the sharpest single drops on record. And credible reports have surfaced suggesting Japan may have begun quietly selling U.S. Treasury bonds to defend its currency. When the single largest creditor nation on Earth starts unwinding its positions, the effects do not stay neatly inside Japan's borders. They travel, they ripple, and they arrive somewhere unexpected. So that is the real story at the center of all of this noise. A real central bank, a real currency under sustained pressure, and a real decision that lands within weeks. The concern is not simply that Japan is struggling. The deeper concern is what Japan's struggle could trigger in the broader global system. Which brings us to the mechanism. The weapon that serious finance people have been quietly worried about for years. It has a name that sounds almost technical, but once you understand it, everything else in this story clicks into place. It is called the yen carry trade. Here is how it works, and the logic is almost brutally simple. For years, major investors around the world borrowed money in Japan at essentially zero cost. Then, they took that borrowed yen and moved it somewhere with higher returns. American technology stocks, emerging market bonds, cryptocurrency, commodities, anything offering a better yield than near-zero Japanese rates. The math was straightforward. Borrow cheap in Tokyo, earn more somewhere else, pocket the difference every single quarter. That trade worked beautifully as long as two conditions stayed true. Japanese interest rates had to stay low, and the yen had to stay weak. Now reverse both of those conditions simultaneously. If Japan raises rates, borrowing in yen suddenly gets more expensive. And if the yen strengthens as a result, the debt you owe in yen gets more expensive to repay in your home currency. At that point, the trade does not just stop working. It actively starts working against you. So every investor running that strategy has to exit. They sell whatever they bought abroad, whether that is stocks, bonds, or crypto, and they rush back into yen to close their positions. That mass exit, that synchronized stampede in reverse, is what market professionals call the reverse carry trade, and we have already had a preview of exactly how violent it can get. The last time this trade snapped, global markets dropped hard and fast, and millions of ordinary investors learned the phrase carry trade for the first time while watching their portfolios bleed in real time. That is why serious voices are raising serious flags right now. Robert Kiyosaki has been warning about Japan's fragility for years. Fund manager Michael Godd has been asking plainly and publicly whether Japan is approaching a moment of panic. And analyst Jake Cleva has gone further than almost anyone, forecasting a 30 to 50% repricing event across global markets if this fully unwinds. In his view, nothing gets to sit this one out. Not stocks, not real estate, not bonds, not crypto. Let me be direct with you here. The reverse carry trade is not internet folklore. It is not a conspiracy theory dressed up with financial jargon. It is a genuine, documented, historically verified risk. If hundreds of billions of dollars in leveraged positions unwind simultaneously, that would rank among the largest deleveraging events in modern financial history. And yes, risk assets including cryptocurrency would feel every single bit of it. But recognizing that a storm can form is not the same thing as knowing when it makes landfall. And the way this particular storm is being marketed to you online, that is precisely where the narrative starts to drift away from reality and toward something else entirely. Before we get there, let us widen the lens, because Japan is not the only data point demanding your attention right now. Think about Warren Buffett. He stepped back from his role as CEO of Berkshire Hathaway at the end of last year, passing operational control to Greg Abel, though he remains as chairman. And the company he spent decades building is currently sitting on a cash reserve that has hovered between $370 billion and $400 billion. To put that in perspective, that is enough to purchase approximately 480 of the 500 largest companies in America outright, with money to spare. Absorb that for a moment. The most celebrated long-term investor in the history of modern capitalism spent his final years at the helm not buying, but building the largest cash cushion his company has ever held. People who believe the future is underpriced do not do that. People who are quietly positioning for a historic buying opportunity do. Then add the geopolitical layer. The conflict in the Middle East has markets watching the Strait of Hormuz with extraordinary intensity. That narrow waterway handles an enormous share of the world's daily oil supply. The World Bank, the International Monetary Fund, and the International Energy Agency have all publicly flagged the stakes if that shipping route remains under sustained pressure. If oil prices spike and hold at elevated levels, everything in the global economy gets revalued. And that pressure does not arrive in a vacuum. It lands on systems that are already showing cracks. And then there is Washington. Kevin Warsh was sworn in as the new chair of the Federal Reserve just weeks ago, making history as the first openly crypto-friendly Fed chair in the institution's existence. But the environment he has walked into is anything but welcoming. Inflation remains sticky. Energy costs are rising. And rather than the interest rate cuts the White House has been openly lobbying for, some experienced traders are now quietly betting that Warsh may actually be forced to raise rates. His first major policy meeting is just days away, and the room he is walking into is charged. Line all of that up side by side. Japan tightening its monetary policy, the smartest patient money in the world, hoarding cash at historic levels. Oil balanced on a geopolitical knife's edge, and a brand new Federal Reserve chair handed what may be the most difficult opening hand in the institution's recent memory. That is not a single risk. That is 4 independent risks leaning against each other at the same moment. And this is exactly the moment, right here, where someone usually leans into the camera and tells you that one specific cryptocurrency is going to save you from all of it. The pitch is seductive, and you have probably heard some version of it already. The yen carry trade unwinds. The dollar and the yen go into turbulence. The world suddenly discovers it needs a neutral, instant, borderless way to move enormous sums of value across currencies. And XRP steps into that gap, the bridge asset, the liquidity savior, 3 digits, then 4. $1,000 XRP riding to the rescue of the entire global financial system in one dramatic weekend. I want XRP to succeed. I know many of you watching this do too. And because of that, I am going to give you the respect that genuine hope deserves. I am going to tell you the truth instead of amplifying the fantasy. XRP cannot play that role right now. And the reason for that does not come from XRP's critics or from outside skeptics. It comes directly from inside the XRP ecosystem itself. Brett Mullen, who works with the XRP Ledger Foundation, was asked recently to identify the single most significant obstacle holding the ledger back from reaching its full potential. His answer was not transaction speed. It was not network fees. The ledger handles its volume without congestion, without the kind of cost spikes that plague other networks. His answer was one word: liquidity. Here is why that answer is so important. The entire promise of XRP as a bridge asset rests on a specific mechanism. You send one currency in, it converts through XRP in the middle, and it emerges as a completely different currency on the other side, near instantly, at low cost. That is an elegant and genuinely powerful idea. But it only functions if there is deep, reliable liquidity sitting in those XRP currency pairs at all times, and right now, that liquidity is still thin, still fragmented, still being built. You cannot route a trillion-dollar global crisis through a bridge that does not yet have the depth to handle it. The math simply does not work. And then there is the regulatory wall, the one that almost nobody raising the $1,000 XRP prediction ever mentions. For the Bank of Japan to even consider reaching for XRP as a settlement or bridging tool, XRP would need to be a fully recognized, legally cleared, regulated financial asset within Japan's legal framework. It is not. Not in the way that a central bank's legal and compliance teams require before they can touch something. The Bank of Japan cannot pick up an instrument it is not legally permitted to hold, regardless of how impressive the technology underneath it may be. So when someone tells you with confidence that XRP hits $1,000 because Japan breaks, they are quietly skipping 2 enormous and non-trivial steps. The liquidity infrastructure is not there yet, and the legal and regulatory door is not open yet. The dream is not a lie, but it is early, and early is a very different word from never. Here is the part I actually find genuinely encouraging. because I want to leave you standing on solid ground rather than on sand. The headline scenario is not real yet, but the quiet, unglamorous foundational progress underneath it absolutely is moving in the right direction. Liquidity around XRP pairs is genuinely improving, slowly, without the fanfare that dramatic price predictions attract. But the trajectory is real. Real-world assets are beginning to appear on the XRP ledger. Tokenized treasury instruments, tokenized stable assets, tokenized debt structures. These are the boring, essential building blocks that have to exist long before any Bridge for the World narrative could ever become operational. The user base is expanding. Developer activity is increasing. Hackathons are happening. Real people are shipping real tools and solving real problems on this network, and the people closest to the ledger consistently return to the same honest checklist of what needs to come together for XRP to fulfill its larger potential. Deep and reliable liquidity, high-quality assets on the ledger, a genuinely active and growing user base, and strong sustained support for the builders doing the foundational work. For the first time, you can look at each item on that list and point to actual, measurable movement. Not promises, not projections, actual movement. So here's how I would hold all of this, if I were sitting exactly where you are right now. Calmly, clearly, without tipping into panic on one side or hopium on the other. Japan is under real and documented pressure. The reverse carry trade is a real risk that deserves genuine respect and genuine attention, not dismissal. The most patient smart money in the world is clearly preparing for turbulence ahead. All of that is true and worth watching closely, but no single cryptocurrency is going to catch a falling global economy in the next year. And that is not a criticism of XRP specifically. It is simply an honest assessment of where we are on the timeline. The real story was never about a dramatic price target printed on a social media graphic. The real story is that the foundation is being poured quietly right now, while the rest of the world is distracted by the noise. If XRP ever does grow deep enough, liquid enough, and regulated enough to matter at the scale that the boldest predictions describe, it will not arrive in a single explosive weekend. It will happen the way every important financial infrastructure shift has always happened. Slowly at first, and then, suddenly, all at once. Is Japan breaking? It is bending, significantly. And that is worth watching with serious attention. Is the reverse carry trade a real danger? Yes, respect it, but do not let it paralyze you. Is XRP going to $1,000 this year and saving the world economy? Not this year, and almost certainly not in the way the loudest voices keep describing. But you came into this video with noise in your head, and I hope you are leaving it with something quieter and more useful, not because the risks have disappeared. They have not, but because you can now see them clearly, and clear eyes will always beat loud noise, every single time. If this gave you a steadier, more grounded way to think through a genuinely complicated moment in global finance, you already know what it means for this channel. Take a breath, stay curious, and stay patient with your portfolio and with yourself. This has been your calm, clear look at one of the most important stories in global markets right now. I will see you in the next one.